Hey everybody, and welcome to IIE Financial's educational series 2 out of 4. This one is titled Selling Options to Acquire Stock. This is a slightly more advanced strategy. This is designed to be seen after you've watched our first one, hence 2 of 4 instead of 1 of 4, where we talked about the basics and the foundations of what options are. Today we're going to go a little bit deeper into options, remembering that there are 2 types of options. Our only 2 types of options are calls and puts. And there's only 2 actions that we can take with those options, buying them and selling them. Now, in our prior presentation, we talked about buying options as a replacement for stock. And this can be done in traditional retirement accounts. This can be done in individual accounts. This can be done in many, many different types of accounts. Today, we're going to talk about selling options. And when we talk about selling options, we're going to specifically talk about selling put options, which are the obligation to buy a set stock. So how do we remember it? Very easy to think about it. If I'm the buyer of an option, a call option will appreciate in value when the underlying security goes up. A put option appreciates in value when the underlying security goes down. Well, as the seller, a call option would appreciate in value when the underlying security goes down, and the put option would gain value as the underlying security goes up. So let's talk about a way that an investor can utilize options, and specifically we're talking today about buying stock at a discount, selling put options as a way to acquire stock at the price the investor wants. So let's think about how money is really made in the financial marketplace. We're going to make it really, really overly simplified here. We buy low and we sell high over a given period of time. So as price moves from low to high, time is always passing. And we've got to remember that. The only thing we know for certain in a market is that time will pass. So one of the advantages of selling options is the fact that we can get paid for the passage of time. So think about what an investor could do if they could get paid by being willing to buy stock at a predetermined price. So let's look at a hypothetical real estate example. I always like to bring it back to real estate because it's tangible and most people understand it pretty easily. So let's say that this real estate investor wants to buy this house for $250,000. He sees the house, he believes it's got a $250,000 value attached to it, and he wants to buy it. Well, the investor, his intention is to buy the house at $250,000 and hold the home until it appreciates in value, and the home is going to be worth $350,000. Now, currently the house is priced at $275,000. Do you think the educated investor is going to overpay? Absolutely not. The educated investor is only going to pay $250,000, what he's willing to pay and what fits into his plan. So now what the investor has to do is wait for the price to come down to him. Well, what if it doesn't come down to him? Well, then he may not buy the home. He may miss out on the opportunity, but he's still going to be following his plan. Even better, what if he could get paid to wait for the price of the home to come down? So that if the price of the home did not come down, the investor would still make some return. And then if the price of the home does come down, he still has collected some premium for being a willing buyer of the home. So let's look at it, in the terms of the markets. A cash secured put is a position where the investor sets aside the cash to buy the security and also sells a put. Now, in selling a put, the investor takes on an obligation to buy a set stock at a set price on or before a set date in exchange for a premium received. Now, many people are afraid of this word obligation in the financial markets. If we have a plan and if we have a pretty good idea of where we want to own the security, there's no reason to be afraid of taking on this obligation. So let's look at a stock. XYZ Corporation, the investor wants to buy 100 shares, and it's currently trading at $53 a share. So the investor has a bullish outlook on the stock and believes that it will rise, but he only wants to purchase the shares for $50. So since he does not want to overpay, what the investor can do is choose to sell a 1-month $50 put option. Now, what that's going to do is it's going to obligate the investor to be a willing buyer of the stock for the next 1 month. Now, over the course of the next month, that stock can move 3 directions. It can move up, down, or sideways, and we have to look at all ways that it can move. So if the stock goes up from 53, then the investor is no longer going to be obligated to buy the stock, and the option that was sold will expire worthless for a profit. What if the stock stays roughly the same? Well, then the investor is going to still keep the premium. And the advantage of it really staying in the same area is that the investor may still want to own the stock, so he can sell that same put again the very next month. Well, what if the stock goes down? Well, if the stock goes down, the investor is still going to keep the premium, and he's going to purchase the shares at $50 a share. Well, it's $50 a share minus the premium that was received. His cost basis is going to be lowered by the amount of the premium received. So let's take a look at an example. So here's a picture of Monster Energy. Monster Beverage Corp. So Monster Beverage Corp was trading at $50.31 a share, pretty similar to the price we were just looking at, on June 17th. Now, if an investor has a price target of $55 in the next month, he can sell the $50 put as a way to acquire the shares at the price he or she is willing to own it. So the July 50 call will bring in the investor $1.15 per share as an extra stream of income. Now, the $1.15 goes into the investor's account immediately. However, the $50 per share is secured so that investor does have the cash available to buy the stock at that price if indeed it goes down to that level. Now, once again, over the course of the next 3 months, the stock can move up, down, or sideways. So looking at this particular example, let's say that stock goes up. Now, if the stock goes up to 55 during the month, the investor can profit from the sale of the option and will not receive the stock. So the investor in this case did not get the movement of the underlying security, only collected the option proceeds. Now, his rate of return on the option proceeds is about 2.3% over the course of a month. Now, it's not exactly a month, it's actually 35 days. So if you annualize that rate of return, the way you annualize that rate of return is that you take the $1.15 received divided by the $50 which is tied up. Now, you then have to multiply that amount times the amount of time in the trade relative to 1 year. So there are 365 days in a year. If we divide that by the 35 days that the investor was in this position, that's a 23.98% rate of return. A pretty strong rate of return for not ever owning the stock. Well, what if the stock goes sideways? Well, if the stock goes sideways and it stays relatively the same, the investor makes the exact same amount. But the difference is when the stock goes sideways, if the investor is still bullish on the security, he can sell that put again in the next month. Now, what if the stock goes down? So if the stock goes down, the stock is now going to be purchased by the investor at the price that he or she wants minus the premium received. So the cost basis of the stock actually goes from $50 a share down to $48.95 a share. That's a savings of 2.3% of the price of the stock, the same as the amount of the credit. So now the investor owns the security at the price he wanted with a little bit of a discount. So when I'm looking at this at the end of the month on 7/21, it was trading at 52.58. We would consider that basically staying at the same level, and the July 50 put expires worthless, and it allows the investor to keep the premium and repeat the process the very next month. Now, this is a way that investors can acquire securities in their portfolios while still increasing their overall rate of return and producing additional income. Many advisors have not shown their clients exactly how this process works, and not because the advisors don't believe in it, but because not every advisor is trained in how to utilize some of the specifics around options. At II Financial, we help investors that are interested in using options in their portfolio in a variety of ways, including stock substitution, stock protection, buying stock at a discount, and collecting extra income by being willing to sell the stock. Call our offices at 832-953-4998 or visit us online at iiefinancial.com if you want more details. Now, stay tuned because in our next section, we'll talk about collecting extra income by being willing to sell the stock. Thank you so much, and I hope you have an excellent day.